Most people are going to get absolutely destroyed in the next market crash. And here's the crazy part. They won't have a clue why it happened. They'll panic. They'll sell everything, and they'll end up with way less money than they started with. Today, I'm going to show you exactly how to position your investments so that when the market implodes, you don't just survive, you actually come out richer. First, I'll show you exactly how compound interest actually works during crashes, because it's totally different from what most people think. Then I'll walk you through 3 specific moves you can make right now to protect yourself. And finally, I'll show you the real data that proves why investors who prepare for crashes always destroy the ones who don't. This stuff is crucial, so hit that like button and let's jump in. Part 1, the problem nobody wants to discuss. Compound interest is more fragile than you think. Compounding, where your money makes money and then that money makes even more money, is absolutely one of the most powerful things in finance. Einstein supposedly called it the 8th wonder of the world. The issue is that most people have zero clue how compounding behaves when markets crash, so they do exactly the wrong thing at exactly the wrong time. Let me give you a simple example with actual numbers. You invest $10,000. Year 1, you make 10%. Now you have $11,000. Year 2, another 10% gets you to $12,100. Compounding is doing its magic. Now imagine year 3, the market crashes 40%. You're not sitting at 13,310 anymore. You're down to 7,260. You just lost everything you made in the first 2 years, plus a big chunk of your original money. But here's the brutal part. To get back to 12,100 from 7,260, you don't need a 40% gain. You need a 67% gain, because losses always damage you more than equivalent gains help you. This is called loss asymmetry, and it's the most crucial math concept in investing that almost nobody understands. This is exactly why people who freak out and sell during crashes often never recover. They sell at rock bottom, lock in massive losses, and then completely miss the bounce back. According to Fidelity Research, if you invested $10,000 in the S&P 500 index fund from January 1980 through 2022, you'd have grown that to over $820,000. But if you missed just the 5 best trading days over those 42 years, 5 days out of more than 10,000, you'd end up with only around 670,000. Miss the best 50 days, and you'd walk away with just 76,000. You took on all the same risk, sat through all the same crashes, but made 14 times less money just by being out of the market at the wrong moments. The goal is to never interrupt it, and that takes serious preparation. Part 2, how normal are crashes really? Before we get into solutions, you need to understand just how common market drops actually are. One of the biggest mistakes investors make is thinking crashes are some once-in-a-lifetime catastrophe. They're not. There are 3 types of market declines you need to know. First is a correction, when markets fall at least 10% from recent highs. These are super common. On average, they've happened about every 14 months since 1980. So if you've been investing for 5 years and haven't seen a correction yet, you're statistically overdue. Corrections are totally normal and actually healthy. Second is a bear market, when stocks drop more than 20% from their peak. Since 1932, bear markets have shown up roughly every 4 to 5 years. They typically last about 289 days, just under 10 months. That sounds rough, but bull markets, the periods where everything goes up, have historically lasted around 965 days on average. That's more than 3 times longer than bear markets. Third is a complete market collapse, drops of 30% or more, often happening really fast. These are rare, but they absolutely happen. Think 2008, think March 2020, think the dot-com crash from 2000 to 2002, where the NASDAQ lost almost 80% of its value. The point is simple. If you're going to invest in stocks, you will see all 3 of these at some point. That's not a warning. That's just basic math. The question isn't whether a crash will happen. The question is whether you'll be ready when it does. Part 3, 3 things you must do with your money right now. This is where it gets practical. These are 3 specific moves you should make today, not when the crash happens, because by then it's too late. The third one is absolutely critical. Move 1, protect your foundation. First thing you need is a financial cushion that you will never touch no matter what happens. I'm talking about an emergency fund, not 2 weeks of expenses, 3 to 6 months of your complete living costs sitting in a high-yield savings account making money while it waits. Here's why this matters more than people realize. During market crashes, people don't just lose investment money. They often need cash for real emergencies, job loss, medical bills, car repairs, all of which tend to happen around economic disasters. When that hits and they don't have an emergency fund, they're forced to sell their investments at the absolute worst time to cover expenses. That's not bad luck, that's terrible planning. A high-yield savings account earning 4 to 5% isn't flashy. It won't make you rich by itself, but it's what keeps you from being forced out of long-term investments exactly when they're on sale. Think of it as insurance for your compounding. Move 2, set up dollar cost averaging and make it automatic. Dollar cost averaging is one of those strategies that sounds basic, but the results are genuinely incredible. Instead of trying to time the market with big lump sums, you invest a fixed amount at regular intervals. Weekly, monthly, whatever works. When markets are up, you buy fewer shares because they cost more. When markets crash, you buy way more shares because they're cheap. Over time, this automatically reduces your average cost per share. During a crash, it does something amazing. It automatically speeds up your buying exactly when prices are lowest. Here's a real example. Say you invest $200 monthly in a broad index fund. Month 1, shares cost $20 each, so you buy 10 shares. Then the market crashes and month 2 shares drop to $10 each. That same $200 now buys you 20 shares. Month 3, the market partially recovers to $15 per share. You buy 13 shares. End of 3 months, you've invested $600 and bought 43 shares, an average cost of just under $14 each. If the market had stayed flat at $20, you'd only have 30 shares. The crash actually helped you build wealth faster. This is why crashes aren't disasters for prepared investors. They're massive discount events. The key word is automatic. Set this up so it happens without you having to decide every month. Because when the market is falling and your account is bleeding red and the news is calling it a catastrophe, your brain will tell you to stop investing. That feeling is exactly when you need to be buying more. Move 3. Get your portfolio properly diversified before the crash hits. This seems obvious, but most people completely mess this up. Diversification doesn't mean owning 10 different tech stocks. It means spreading your money across different asset classes, different sectors, and different countries, so that when one area gets destroyed, the others can absorb the damage. The exact percentages depend on your age, risk tolerance, and timeline, but the principle is the same. Never put all your money in one bet. Here's why this specifically helps compounding. When one part of your portfolio crashes, you can rebalance, sell some of what's done well, and buy more of what's dropped. This is force buy low, sell high, the exact opposite of what most people do instinctively. Over time, rebalancing significantly improves returns because it keeps your compounding working across your entire portfolio. One important thing, diversification is way harder to maintain during good times than bad times. When one stock or sector is absolutely crushing it, it feels wrong to move money out of it. Why would you sell Tesla when Tesla keeps going up? But that concentration is exactly what destroys people when crashes come. During the 2008 crisis, financial stocks dropped over 55%. During the dot-com crash, tech stocks lost more than 70%. People who were heavily concentrated in those areas didn't just lose money. Many lost decades of compounding progress. Part 4, the psychology problem and how to fix it. I want to spend time on this because it's what actually determines whether most people succeed or fail as investors. It's not the strategy, it's the psychology. Here's what happens during a crash. Your portfolio drops, maybe drops a lot. You open your investment app and see numbers deep in the red, and your brain, which evolved over hundreds of thousands of years to respond to threats, start screaming at you to do something. Get out, stop the bleeding, sell everything. This is called loss aversion, and it's one of the most documented things in behavioral economics. Research by Daniel Kahneman and Amos Tversky found that the pain of losing money is roughly twice as powerful as the pleasure of gaining the same amount. Losing $1,000 feels about twice as bad as gaining $1,000 feels good. This is hardwired into us. It's not a character flaw, it's biology, but it's absolutely deadly to long-term investing. The solution isn't to somehow stop feeling the fear. The solution is to make decisions before the fear kicks in, when you're calm and rational, and then commit to following those decisions even when everything in your gut tells you not to. This is why you need a written investment plan. Seriously, write it down. It should say what you're invested in and why, how much risk you're comfortable with, what you'll do if the market drops 20%, what you'll do if it drops 40%, and how long you plan to hold your investments. When the crash comes and your emotions are running wild, you can pull out that document and remind yourself that you already made this decision. You already knew this might happen, and you already decided what to do. Peter Lynch managed the Fidelity Magellan Fund from 1977 to 1990, delivering an average annual return of 29% over that period, one of the best long-term records in history. But he noticed something fascinating. Even though the fund returned 29% a year, many investors in the fund lost money. Why? Because they bought when performance was hot and sold when the market dropped. They let their emotions override their plan. Don't make that mistake. Part 5, what the data shows about staying invested. Let's finish with the numbers. We already talked about the Fidelity study showing that missing just the 5 best trading days between 1980 and 2022 cut your returns from $820,000 down to $670,000. That's a difference of $150,000 for missing 5 days. But here's the thing about those best days. According to JP Morgan research, many of the best trading days in stock market history happened during or immediately after crashes. 7 of the 10 best single-day returns in S&P 500 history occurred during the 2008 financial crisis. If you sold during the crash to protect yourself, you didn't just lock in your losses. You almost certainly missed the rebounds that followed. This is the brutal irony of panic selling. The people who sell when things look terrible are often the same people who miss the days when things turn around. And because of the loss asymmetry we talked about earlier, the fact that you need much bigger gains to recover from losses, missing those recovery days is devastating to your long-term returns. Now let's look at what staying invested and continuing to dollar cost average through a crash looks like in real life. Between October 2007 and March 2009, the S&P 500 fell approximately 57%. Absolutely brutal. If you had $100,000 invested at the peak, you watched it fall to around $43,000. That's genuinely terrifying. But if you kept investing $500 a month throughout that entire period, you were buying shares at bargain basement prices that would eventually recover to much higher levels by 2021. The crash didn't hurt you, it set you up for massive gains. Same thing happened in March 2020 when the COVID crash hit. The S&P 500 dropped 34% in about 5 weeks, one of the fastest declines in market history. Investors who panicked sold at the bottom. The market had fully recovered by August 2020, about 5 months later. People who stayed in, or better yet kept buying during the dip, made extraordinary returns over the next 2 years. This isn't luck. This is compounding doing exactly what it's designed to do when you let it work. Here's your complete action plan. Market crashes are not rare events. They happen regularly. Corrections every year or two, bear markets every 4 to 5 years, and more severe collapses every decade or so. If you invest long enough, you will live through all of them. Compounding is extraordinarily powerful, but it can be permanently damaged if you make emotional decisions at the wrong moment. The asymmetry of losses means that being out of the market at the wrong time costs far more than most people realize. The 3 things you need to do right now are: Build a real emergency fund so you're never forced to sell at the bottom. Set up and automate dollar cost averaging so your investing becomes a system rather than a decision. And make sure your portfolio is diversified so that no single sector can wipe out everything you've built. Most importantly, write a plan, commit it to it, and don't let the fear that comes with every crash convince you to abandon a strategy that the data has proven works over and over again. The people who get rich through market crashes are not smarter than everyone else. They're not luckier, they're just prepared. And now you are too. Remember, I'm not a financial advisor. This video is for educational purposes only, and any results depend on your own decisions and actions.